Hello everyone. So guys, we are going to discuss today investment decisions. Okay, and please remember this section, this sole chapter, one chapter is 10% of your exam. So in investment decision, actually we will go through these things. We will talk about like what is capital budgeting process. Okay, then we will discuss about risk analysis and real option. And we also have another topic which is called discounted cash flows analysis, in which we will learn how to calculate net present value, IRR. Then we have a topic again, payback period and discounted payback period. So then we have a ranking investment projects. So actually these are the list of the topic. But to understand this whole unit, because it is all about investments in the long-term project, this chapter. So like, for example, if you are investing in long-term project, like maybe you are going to undertake a construction contract, okay, maybe which will last for many years. So how you will evaluate that investment, or how would you take decision, okay, that should we invest into that project or not? So, or for example, maybe if you are going to erect a new factory, or you are going to set up a new business, or maybe you are going to buy even new machine. So just we want to evaluate. So whatever money we are going to invest into that option, that money will give you some profit or not, right? So this is what we actually, this whole chapter is about evaluation of investment decisions, which investment decisions, especially long-term investment decisions. But to understand this whole chapter, so first we need to understand basic idea. So because today I'm going to explain the basic thing, which is a time value of money concept, because without that you cannot understand this chapter. So today we will spend the time on time value of money, how to calculate present value, future value. So before moving to that, guys, so I just want to tell you first thing. So that is what is the concept of timeline. First, I'm going to tell you what is timeline actually. So obviously, guys, it is one of the convention which usually we use in the investment decision, right? And it's really important convention. It's a really important concept. So let's understand what it is. For example, so we are going to start a project. So that project may have 8 years life or 10 years life. So first we need to draw the timeline. Timeline, this is for example, let's assume our project is having 5 years life. So what we will do, we will like draw a line. For example, this is the line, okay? You can see here. So in this line, for example, we assume this point is year zero. Year zero means say it is today. For example, it is also called current time. It is also represent today. Okay. Then we will write here year one. Year one means this point means say at the end of year one. Then we have a year two. This year two means say at the end of year two. And this point represent year three. It means it is the end of year three. And this point represent, for example, year four. This is the end of year four. And this point represent, for example, year 5. Now, guys, this is the timeline. Why we need to understand this timeline? So because whenever, for example, so you are going to start a project. So initially, maybe you will invest. Okay, maybe initially the project requires investment. Maybe you need to buy some plant, machinery, right? A kind of non-current asset which you need, or maybe sometime you may also invest in current assets, right? So like this is the like timeline in which you have to write, or in which we have to decide where to write the cash flows. Cash flows means, say, for example, if you are investing into the project, so we'll write always investment in year zero today. So and this investment is considered as investment in the non-current asset. Then, for example, here, if, for example, if you are receiving something, let's assume maybe if you will start a project, or maybe if you will invest into a machine today, so machine requires, let's assume, $100 of investment. So you will always write in year zero in bracketed figure and in as a negative value. For example, this machine may earn for you as an inflow in future. Maybe at the end of first year, this machine can earn a profit for you or cash flow for you $30. Maybe here it can earn $40. Maybe here it can earn $50. Maybe here it can earn $40. And here maybe that machine is earning here, let's assume $60. I'm just saying. So actually this timeline will give you idea where to write the cash flows. Cash flows mean to say both cash flows. It may include investment as negative cash flows. It may include inflows as a positive cash flow. Investment means it is outflow. And for example, maybe whatever earning you will earn from that project in the future, those are called inflows. So now let's go through here. So we are going to just discuss what does mean by this timeline here now. So for example, I told you this point, which is called year zero. Year zero represents today, or it is also called current time. So for example, if it is said that 5 million is invested in the project today, okay, or maybe you have invested in the project now, for example. So what we have to do in the year zero, we have to write cash outflow of 5 million. Here you will write 5 million as a outflow. Understood? Then guys, this point, year one represent mean to say 12 months. It represents 12 months from today. Or it means it is like a 1 year from today. Like it is after 1 year. This is after 2 years. This point represent after third years. Okay, or after or at the end of 3 years. Or I can say this way. This point represent what? After 36 months from today. Because today is year zero. From here, how many months are there? 36 months. So it means so these are considered as a end of each year. Like this end of year one, this end of year two, end of year three, end of year four, and the end of year five. As I told you, why we need to understand this timeline, because we will place cash flows. Okay. In future lectures, we will place cash flows yearly. Okay. So that is why it is important to understand concept of timeline. Then here guys, we have here, this is I already told you, cash outflows are always shown in negative or bracketed figures. But if you have cash inflows, maybe you are receiving cash inflows at the end of first year, and maybe you would receive at the end of second year or third year. So inflows you have to write as a positive value. So actually you can say this timeline simply, it is a life of the project, which you are writing in terms of years. Then what do we have a next thing now we need to understand? So the time value of money. Okay. So what is time value of money concept? So let me guys first give you idea why we are understanding this topic, why we are going to go through this topic. So it is really important to understand it. So for example, I'm just assuming. So for example, today you are investing, let's assume $100. So you will write in year zero. At the end of year one, maybe you will receive $30. Here maybe you will receive $40. Here you will maybe receive $30. Here maybe you will receive $40. Here maybe you will receive $30. I'm just assuming. So how much inflows you are receiving? For example, in year one, 30 plus 40 plus 30. So it is going to be 100 plus 140 plus 30. So 170. Total inflows are 170. So this is what is your total inflows over the life of the project. But total investment is what? 100. Now, guys, please remember this value which you know today or which you write in year zero, this is called present values also, like today's value. But these values which you will receive in the future, so these values are called future value. Okay, I'm just telling you the importance of time value of money, why we are going to study. So guys, see, being a rational investor, you should never compare this outflow with this inflow. The reason, so because this is stated in terms of present value, in terms of today's value, but these are future values. If you are taking decisions in terms of present and future values, like you are comparing this present value with this future value, this is totally illogical. So what we have to do, we are going to learn time value of money concept, in which we will learn how to convert these values into today's terms. Like all future values we will convert into today's terms. All values we will bring back to the today's terms. And by the way, this process is called discounting process, that you will understand obviously, but after a few minutes. So what we are going to do, so because we have investment in today's terms, so future values we will convert into present values. Because when you convert future values into present values, okay, in today's terms, that is also present value. Then you will compare like how much outflow you have, how much inflows you have in terms of present values. Okay, then you can take decision based on that, your outflows are more or inflows are more, right? So this is what, that is why we need to consider time value of money. So now I'm going to tell you what is time value of money. I will take you to the discounting process, but it will take time, obviously. So first I'm going to start from the scratch. So first thing, here we go. So what is the time value of money? Okay, time value of money, I'm going to tell you now. So the concept of the time money value of money is we always say money loses value over time, or money loses value with the passage of time. So you will agree with it. I'll just give you one simple example. There are several reasons why money is losing value over time. So one reason could be inflation. For example, let's assume if you will look back 1 decade ago, let's assume, for example, I'm assuming 10 years ago, for example, if you were buying 1 liter of petrol, maybe at that time, I'm just assuming, for example, maybe you are paying $1. I'm just assuming $1 for 1 liter petrol. But today's after 10 years, maybe today, this is what before 10 years. 10 years before. 1 liter, the price of 1 liter was $1. Now, for example, I'm just assuming, now after 10 years, it means now, 10 years passed, after a decade, now if you're buying 1 liter of petrol, maybe you are paying what? $3. I'm just assuming. These are just assuming value. So now see what happened. Quantity has not changed. Quantity is the same 1 liter, 1 liter. But what happened? Previously, you are paying $1 to buy 1 liter. But now you are paying $2 or $3 to buy 1 liter. It means what? Money has lost the value over the passage of time, because previously you were paying less for the same quantity. Now you are paying more for the same quantity. It means money loses value over time. So by the way, this example I gave you in context of inflation. So there are several reasons that I'll tell you. Okay, so then this is the first line I told you. Money loses value over time. Then what? Then this can be written this way also. Money received today is worth more than same sum received in the future. Okay, it has a time value. So what it means, for example, if I'm giving you option today, I'm saying that, for example, I owe $100 to you, and I'm giving two option to you. I'm saying that $100 you can take it today from me, or $100 you can take after 3 years from me, after 3 years. So what you would prefer? Obviously, you would prefer $100 today. Why? Now you have to think why. Why you're preferring today's value? Why not $100 after 3 years? Because you may think this way. So this way also, this is another reason. So maybe you may think this way. If $100 you will get today, maybe you can deposit simply into the bank. If you will deposit into the bank, so if you will deposit today into the bank, so you have opportunity to earn 3 years interest. Maybe after 3 years, if you are earning interest, maybe this $100 can be converted to 100 and let's say $20. But in the other option, so after 3 years, if you will receive $100 after 3 years from me, so you will get only $100. So here you are losing interest. Okay, losing interest. Why you are losing interest? Because you are not investing. And other reason what? So another reason I can again I give you second reason why you prefer today's money, or why today's money is having more worth than future. The second reason is inflation, I told you. So for example, the thing or any product which you can buy for $100 today, maybe after 3 years for the same product, you maybe have to pay $130. So it means today money is having more worth. Third reason could be what? I told you two reasons. First thing, today, if you will receive money today, you have a opportunity to earn interest. Okay, second reason I told you, you can save yourself from effect of inflation. Third, I'm going to tell you risk of default. What is risk of default? Like for example, today if I'm giving you money, so it's better for you. If I'm making promise, oh, I will pay you after 3 years. Maybe after 3 years I will disappear, right? I may disappear, and then you will search for me where he is. So that is why it is better for you to receive money today. So that's why we say today's money is having worth more than same sum received in the future. Understood? So that is what is the time value of money. Now I'm going to start. I told you already there are three reasons for the time value of money, that why money loses value with the passage of time, or why money is having more worth, okay, than the same sum received in the future date. So there are three reasons I told you. Potential for earning interest. This is I already told you, which is also called cost of finance, that if you will receive today, you may invest somewhere, you may have opportunity to earn interest on that or profit on that. So second reason I told you, you can save yourself from the impact of the inflation. Third, I told you, you can save yourself from the risk of default, right? So this is what these three reasons are there. So I'm going to touch this reason because this will build your foundations, okay, in learning the time value of money concept. So here we go, potential for earning interest. First reason I'm going to open, because calculations are based on this, by the way, at this point. So here we go, guys. What does mean by potential for earning interest? Potential for earning interest means, say, if you would receive $100 today, so this money you can invest, right? You can invest today, and you may have the opportunity to earn interest or profit. Right or wrong? So it is better to have $1 now than in 1 year, because, for example, if I'm giving you two options, you can take money today or after 1 year. It is better for you to have $1 now than in 1 year, because $1 now can be invested for the next year to earn interest. Understood? But if you will take money $1 after 1 year from me, so then you will not have opportunity to earn interest, because actually, at least you will lose this opportunity which you had previously. Understood? So now here we have here which kind of interest actually we are talking about. So there are, by the way, two types of interest are there. One is called simple interest, and second is called compound interest. Okay, we have a simple interest, we have a compound interest. So like when you invest, okay, and you want to earn interest, so there are two types of interest structures are there. So in terms of finance, I'm talking about. So you may earn simple interest and compound interest. So what's the difference in the simple interest and compound interest? So here we go. First, I'm going to explain about simple interest. Guys, actually, in simple interest, what is the main principle? So here in the simple interest, what we will do, we will always calculate the interest on original investment. And what we are assuming, so for example, if you are investing today $100, maybe after 1 year you will get, let's assume, $10 as a interest. So the interest whatever you will get, so we are assuming that interest we will not reinvest for the future period. We will not reinvest. Interest will not be reinvested under the simple interest. So what is the thing? It means if you are not reinvesting the interest, you are not reinvesting the interest what you have earned. So it means every year you will get interest on original investment, because interest whatever you are earning, you are, let's assume, withdrawing it, and you are going to use it. You are not going to reinvest. So this is what is the idea behind simple interest. So here interest will be calculated always on original investment. So let's have a look. I'm just giving example how simple interest can work, and then we'll see what is the effect of a simple interest or compound interest, and what's the difference. So for example, let's assume you are investing $100,000. Today you are investing, and this investment is for 3 years, okay, at the rate of 10% per annum. And what is the principle of interest you are going to follow? Simple interest. So it means you are investing 100,000 today at the rate of 10% per annum, and this investment is for 3 years. Now, if you are calculating interest, how would you calculate? So first of all, guys, let's say you will write year 1, 2, 3, because this investment is for 3 years. And make sure you are calculating interest always on original investment. So how would you calculate interest? You will take amount of investment, which is 100,000, multiply by rate of interest, which is 10%. So this will give you 10,000 as an interest. And this interest, I'm not going to reinvest. I'm going to withdraw and use it. Next year, again, what is the amount in the bank? Again, you will have 100,000 original investment, because interest, whatever you have earned, you have withdrawn and you have used it. So now, guys, next year again, we have 100,000. Again, that 100,000 will be multiplied with the 10%. So we'll get again interest of 10,000. That will be withdrawn again, and we will use it. So again, it means in the bank, we have investment of original investment. Okay, the value of original investment. So here we have, for example, 100,000. Again, in the third year we have multiply by 10%. Again, you will get interest, and this you will withdraw and use. Okay, and this process can continue for the future if you're investing for more years under the simple interest principle. Now make sure here how much money you have earned in terms of interest. You have earned here $30,000 in 3 years. This is what simple interest. Now think how the result would change if you would invest under the principle of compound interest, not simple interest, compound interest. So if we go under compound interest, this is how you will go. Under compound interest, please make sure, guys. So first thing, what we are going to do here. Okay, so whatever interest you will earn, that interest we will not withdraw and we will not use. What we will do then, we will reinvest for the future period. It means under compound interest, so interest will be calculated always on accumulated investment value. Okay, cumulated means accumulated, which may include amount of principal also plus amount of interest. So here we will calculate, okay, interest on cumulative value. So how it is going to work? Let's have a look. Same example I'm taking and see the difference how things are working. So guys, for example, you are investing of $100,000 for 3 years. Okay, at the rate of interest again 10% per annum. And again, but now your principal of interest is what? Compound interest. This is what you are investing under this principal now, under compound interest. Okay, so how would you calculate interest for 3 years? So here we go. So first we'll write year 1, 2, and 3. And here we have accumulated investments. Then we have here interest column. So in year 1, we have investment of 100,000, right? In year 1, at the start of year 1, we invested 100,000. Now at the end of year, you will earn interest on this 100,000. So if you will take investment value, multiply by rate of interest, this will give you interest value. And now this interest we are going to reinvest. We are not going to withdraw. It means next year your investment will be what? Principal value plus interest. So next year your total investment will become 110,000. And now you will calculate interest on 110,000. 110,000 multiplied by 10%. Your interest would be 11,000. Again, this value we will also reinvest. Now, how much investment you have at the end of second year? You at the start of second year, you have 110,000 and you earned again interest of 11,000. So at the end of second year, you have interest, you have a accumulated investment of 121,000. What I'm doing, I'm adding these two values, right? Interest and opening value and interest. And third year, at the start of third year, you have actually $120,000 of investment. Now what we will do, we will multiply this investment with the 10%, you will get interest again. Understood? Now if you will notice one thing, so here how much is the interest which you are earning? If you will add these three values, I believe it is going to be a 33,100. I'm not sure, just you can recheck the calculation. Okay, so 33,100, let's assume. And if you look under the simple interest, so you are earning how much? Only 30,000. So how much you are earning more under the compound interest? Almost you are earning 3,100 more under compound interest. What's the reason? The reason is the interest you are not using, you are reinvesting. This is what is called, compound interest. Now, guys, now we are coming to the main point. Now, look, this calculation was only for 3 years. Now, assume if you are doing this calculation, if I'll change this value here, like you're investing 100,000, but not for 3 years, for 20 years, let's assume. Okay, and now I'm saying that calculate the compound interest after 20 years, what will happen? So now see, you have to create 20 rows. It will take too much time, right? So that is why to make shortcut under finance, what we have compounding formula. So what compounding formula will do, automatically by using that formula, we can convert our investment, our present values, which is today's value, into the future value. Like what will be the value after 20 years or 50 years? Okay, so that is called compounding now. Okay, by the way, what is compounding? When you are converting the values from present and you are calculating future value. Simply when present values are converted into future value. So this process is called compounding. And how would you convert present value into future? So simple idea is very simple. You should take present value, what is today's value. In that you should add interest for X number of years. So then it should give you future value. It means in future value, you will have present value plus interest element. So for example here, so this was the present value and this is present value today you invested. This is the future value at the end of the first year. At the end of first year, how much is the value? 100,000 plus 10,000, 110,000. At the end of second year, how much is the future value? You should add this 110 plus this 121,000. Okay, at the end of third year, you should add these values, for example. So whatever 133,100, for example. Okay, so these are future values. Because these values includes what? These value includes original investment plus interest. This is what is happening under compound interest. So now, guys, I'm telling you in compounding what formula you can use. So here, guys, because uh, there are some technologies in the market like finance calculators. So there we can tackle different types of cases. But here what I'm talking about, we are talking about here how to calculate future value of a single amount. This is the main thing because future values can be calculated in annuities also. What is that? I'm not going into that detail. So I'm talking about here how to calculate future value of a single amount. Single amount means, say, for example, if you know this much money, if you will invest today, one-time investment, okay, single amount, okay, one-time investment, and what will be the future value after 10 years or 15 years or 30 years? So that is called what? Future value of single amount. So here we go how the formula is going to work. So this is the formula. So this is the formula which we can use. It's written here. Future value, if you want to calculate, you need first present value. And in that present value, you need to add interest. And for to add interest, what formula we will apply? We will say 1 plus R. R stands for rate of interest. Raised to power N stands for number of periods. For example, if you want future value after 3 years, let's assume, as per this example, because in this example, what we were taking, we invested $100,000 at the rate of 10%. Okay, at the rate of 10% for 3 years. So what is the future value after 3 years? So how you can do it? It's very simple. You will apply this formula now. So present value was 100,000 because you are calculating future value. Multiply by interest rate 1 plus R. R means 10%. So it was, when you will remove the percentage, it will become 0.1. Okay, raised to power N. N is what? 3. If you will keep this 3. So for example, if you will solve it, so 100,000 multiply by here. This is called future value factor. Okay, this future value factor. So uh, I'm not sure I can tell you from the table because table is also available in your exam. This is future value factor. I'm using future value factor. So I'm showing you table here. See, this is called future value of $1 table. And this is the formula is applied to calculate 1 plus R raised to power N. Okay. So for example, what was our rate of interest? It was 10%. So you will, if you look at it horizontally, percentages are written and vertically periods are written. So rate of interest is what? You have to select what was the rate of interest? 10%. And for how many years you are calculating? So look, these are the years 3. So just we'll move to a 10% column. So this is the value 1.331. This is called future value factor of $1. $1 means of single amount. Okay. So if you will solve 1.331. So guys, even if you will solve this 1 plus 0.1 raised to power 3, it will give you 1.331. Okay, if you will now solve, you will get what? $133,100. So this is the future value after 3 years. Now, for example, if you want future value after 2 years, okay, so what you will do? So just change the N here. Okay, if you will change the N here, just make it 2. So then again, rate of interest is 10%, and now it is 2. You can go to the table. This is the 10% rate, this for 2 years, 1.210. 1.210. If you will multiply, it will give you maybe 121,000. Okay. This will be the value, future value. So instead of doing these things in this tabular form, so we can apply this formula, and this formula is called compounding formula. Okay. So compounding formula. So what I told you, we will take present value into 1 plus R. R is what? Rate of interest raised to power and stand for number of period. Okay, guys. So please. So guys, so far I told you how to use the future value of $1 table. This table will be given in your exam of CMA. Okay. So simply I told you, whenever you want to calculate future value, you should take future value equals present value multiplied by 1 plus R. R stand for rate of interest raised to power N stand for number of period. And obviously, if you know rate of interest, so you should select the rate of interest from this information. And if you know the N, so you can select the N from here, and then you can search for a future value factor. Understood? So then you need not apply this formula. So simply we can say future value equals present value multiplied by future value factor. And this factor you can find from this table. Because this side is called future value factor. And future value factors will be available in this table. I hope so it is clear. For example, if R is 5% and I'm saying that N is 3. So what is the future value factor? Future value factor. So we'll go to the 5% and N is 3 and 3. So this is the value 1.158 will be the future value factor. Okay, this is how you will work with this table. Then guys, we have now, I'm going to talk about present value. Previously, what we were doing, now please listen what I'm saying. Previously, we were calculating future value. Okay, and how you were calculating, you were taking present value multiply by 1 plus rate of interest raised to power n. Now assume we want to calculate this value and other values are known. Okay, other values are known. So what you will do now, how, please, it is really, really important formula, which I'm going to tell you. So please remember here how to calculate present values if future values are given and other information is known, R is known, N is known. So now formula can be written this way. Please listen, it's really important. So present, first way to write is present value, which you want to calculate now, equals future value divided by 1 plus R raised to power N. So this is mathematically, this formula, you can write this way. This is the first way to get present value. So present value equals future value, okay, divided by 1 plus R raised to power N. This is the one way. Second way, you can write this way also, second way. So present value equals future value multiplied by 1 divided by 1 plus R raised to power N. It's the same thing. Even you are writing this way or writing this way, mathematically, it's same thing. Okay, third way, which we will mostly use. Okay, so that is what. So if you want this, the third way, I can write this way also. So present value equals future value, right? Multiply by, see, now I'm multiplying what? 1 plus R raised to power minus M. So because this thing can be written this way also. This way also. So present value equals future value multiplied by 1 plus R raised to power N. Okay, so I told you previously, when you are doing compounding, please remember, in compounding, what you are doing, you are converting present value into the future value. Compounding, I told you previously compounding formula. So you are converting present value into future value. And what you are doing, you are adding interest for X number of years into the present value to get future value. But when now you are converting what? Now you are converting future value into the present value. And what you will do now, so you will roll back or you will deduct interest for X number of years from the future value. So you will get what? Present value. And this process, when you convert present value to future, this is compounding. But when you convert present future values to present value, this process is called discounting. In discounting, what we have to do? Future value will be given. From there, we have to remove the element of interest for X number of years. So then you will get the present value. And by the way, when you apply this formula, so this is what all formulas are for discounting. Yeah, like how to calculate present value. Because sometimes once you will read the solution of your exam questions or maybe or of your software questions, so maybe sometime he will use this way, sometime he will use this way, or sometime he will use this way. So all are the same thing. So this is what is written here. I hope so you understood. It's just a mathematically. So please remember here I'm talking about first again present value, how to calculate present value of a single amount. Single amount means a single future value. Our future value will be given. Simply you have to convert into the present value. That I'm telling you. So here we go. A single amount doesn't mean you have only one amount. You may have different amounts, okay, of inflows that can be converted into the present values. So here we go. The formula we will see. So please remember, guys. Now in this formula, if you will look at here again, this thing I'm just highlighting, which is 1 divided by 1 plus R raised to power N, or which can be written this way also, which is 1 plus R raised to power minus N. This is called present value factor. Present value factor. And this present value factor will be given. This present value factor will be given in the table of $1 table. This is the name of table. Previously it was future value of $1. Now it is a present value of $1. So you will consult that table. Okay, their present value factors are given. So for example, I'm just applying here. So let's assume if I'm just saying, just calculate the present value factor. For example, if R is 10%, okay, and N is 3. So what is the present value factor? I'm saying just factor. And for the factor, what was the formula? For the factor formula was 1 plus R raised to power minus N. Okay, so 1 plus R. R means the rate of interest, which is 0.10. N here how much? Minus 3. If you will solve it, I believe it will give you 0.751. Okay, 0.751. And this thing you can find in the table also. This is a table I'm showing you here. Present value of $1 table. Present value of $1. See here again, the percentages are written. Here number of periods are given. So rate of interest was 10 because R was 10% and N was 3. Okay, so if you will go to 10% and look in the third period, so you will find this value 0.751. The same here if you want to calculate present value factor. If R is 10% but N is 2, so you will apply formula 1 plus 0.10. 0.10 means rate of interest minus 2. So now you will find this value 0.826 because at 10% for 2 periods, this should be the answer 0.826. It means now I can add fourth formula for present value. Present fourth formula is what? So we need not to work with this formula. Simply we can took the value from the table. And how would you work now? Present value equals future value multiply by what? Present value factor for relevant year. For example, if N is 5% and periods are 6, so you will go to 5% column and 6 period. This is 5% column. This is 6 period. So we'll move to the value and we have this value. We'll select this value. Okay, because even if you will apply this formula 1 plus 0.05, which is rate of interest, minus 6, so you will get this value. Okay, so this is what we are going to do. Now we are just converting present values here. I'm showing you small example. For example, let's assume let's assume these are the present value factor. Okay, factor. We told you factor at 6%, factor at 8%, factor at 10% for year 1, 2, 3, 4, and 5. And same factors are given in the table also. Just these factors are extracted from the table here. So for example, if you want, so let's assume they're saying the present value of $1,000 to be received in 3 years. Like there is $1,000 which you will receive in 3 years or after the end of the third year. So are discounted at 8%. So if you will discount at 8%, so what is the present value? So what you will do? Simply you will apply this formula now. Present value equals future value multiplied by present value factor for relevant year. And future value, he told you after 3 years, you are getting 1,000. And rate of interest is 8%. Now you will go to 8% column. And for how many years it was invested? For 3 years. So we'll pick 8 years for third year value. So it is going to be 0 multiplied by 0.794. If you will multiply these two values, this is going to give you present value of 794. Now what it means? It means that $1,000 which you will receive after third year, that is equal to today $794. Okay, like this value, which is the future value, is equal to $794 in today's term. Okay, this is what is present value. So this is how you will use the present value of $1 table. I hope it is clear. Now just I'm showing you. Now guys, we have here something new. It is really, really important. Now we are going to see, I told you previously how to calculate future value, which is called compounding. I told you how to calculate present value of the single amount. Now I'm going to deal with what? Annuity. And this is what is the most tricky cases. Here I'll tell you how you will use the tables, or I'll tell you one new table also. So first, let me tell you what does mean by annuity first. This word I'm explaining. In finance, what does mean by annuity? So annuity mean to say, actually, it has 3 features. If any cash flows are having 3 features, that will be treated as annuity. What is the feature? Feature number 1. For example, if I'm telling you, let's assume I took your house on rent, for example, for 3 years, year 1, 2, and 3. And I told you I will pay you rent yearly 10,000, 10,000, and 10,000. Now, actually, this is the annuity condition, annuity situation. What is annuity? So there are a series of even cash flows, right? Series of even cash flows is the first condition. And these cash flows are arising after regular interval. Regular interval means a yearly I'm giving you. I'm giving you here at the end of first year, at the end of a second year, at the end of third year. Or I may give you at the start of first year, at the start of second year, or at the start of third year. But these are evenly rising. Evenly rising after regular intervals. Third point is what? You know this cash flow will arise for how many years? Only 3 years. It means these cash flows are for definite period, for defined period of time. Period is known. If you have this kind of situation, that is called annuity. I'll give you another example. For example, you are taking life insurance. Okay, they told you have to pay premium. Let's assume premium for 10 years. Every year you have to pay premium, and you will pay premium of $100,000 every year. Now it is also annuity because there are even cash flows 100,000, 100,000, 100,000 you will pay over 10 years. And obviously this you will pay yearly, regular interval is also there. And what third is what this is for 10 years only. So the time period is also there. So this is what is called annuity situation now. So guys, now in annuity, actually, please remember here, if you want to calculate present value, so it will take too much time. Let me tell you here. For example, if you will use present value factor of $1, let's assume. So you have 3 years, year 1, 2, and 3. So these are your cash flows. Let's assume. Okay, cash flows, payments are receipts, 100,000 a year, 100,000 a year, 100,000 a year. Because it's annuity now, because cash flows are even rising after regular interval and for defined period of time. And now if you want, I want you to calculate present value, what you will do? So you will multiply cash flows with the present value factor from $1 table, from $1 table. So this will give you present values, right? Because future cash flows, you will multiply with the present value factor of $1 table. So you will get present value. See how, let's assume rate of interest is 10%. I'm assuming. So it means you will look at the 10% column. So simply you will go to the table, present value of $1 table. So if you look year 1, so there is a value is written 0.909. If you look year 2, it's written 0.826. And if you look third year, it is written 0.721, for example. These values are written in the table at 10% column. Okay, so these value I'll pick now. So 0.909, here I'll multiply 0.826, here I'll multiply 0.75, 721 or 57. Let's confirm what's the value. At 10%, it is 909,826,751. 751. Okay, so if you will multiply like 100 with this, because present value formula is what? Present value equals future values multiplied by present value factor. So future values are this, present value factor is this. If I'll multiply, obviously I'll get present value. So if I'll multiply here, you will get 90.9. Here you will get maybe 82.6. If you multiply this, it is 75.1. So these are present value. If I want to make total, I'll add these present value. So this is going to be my total present value. So see, if I'll just add these three value, how much it is going to be? 90.9 plus 82.6 plus 75.1. So it is going to be 248.6. Right? So this is what is your present values total. Right? So now guys, annuity, what we are discussing, well, this is the annuity situation. So we can, please remember, we can get this calculation very easy. Okay, and on single calculation, we need not to do this much calculation. So annuity table actually will give you shortcut. So what is annuity table? That I will explain, don't worry. So here we go first. So what I'm going to explain, here we go. So this value, how you can get in shortcut, if you are following annuity table, because this present value you can get in simple word. So you will get present value now equals future value per annum. This word is really important. because there are three cash flows are there, $100, $100, $100. Don't take it here $300. It's wrong. You have to do future value per annum, which is 100. And multiply by, you have to multiply with the annuity factor now. Annuity factor I'll explain, don't worry. But let me show you first table there. Huh? Annuity factor. Annuity factor, how you will select? Because rate of interest is 10% and these cash flows are for 3 years constant. Constant cash flows are there for 3 years. So what I'll do, if I'll go to 10% column in the annuity table and for 3 years, this is the annuity table, guys. I'm showing you annuity table. This is the annuity table. It will be given in your exam with the name of present value of ordinary annuity. So I'll go to 10% and for 3 years. This is annuity table because this is third year. Na? So this will give you annuity factor. So annuity factor I'll take 2.487. So present value I'm calculating if cash flows are even. I'll take future value per annum multiply by annuity factor. Annuity factor I'll pick now from annuity table, which was how much? 2.486, I believe, or 685. So this was annuity factor. If I'll multiply with this value with this, automatically I'll get present value, which is 248.6, which is equal, right? So now you got two ways here. See, you can use present value factor. You can use annuity factor also, right? But present value factor, you can use in both situations. If you have a even cash flows, like every year it is same, or even it is uneven cash flow, you can use present value factor. But annuity factor can be used only in one scenario, if cash flows are even every year. Then you can apply. And this is the formula normally you will follow. Present value equals future value per annum multiplied by annuity factor. It means annuity factor is nothing. It's not anything, something is new. That I'll explain what is annuity factor, don't worry. But it is not something new. It is actually the shortcut way to do the calculation. So now here I'm explaining what is the annuity factor. See, annuity factor I'm going to tell you. How I told you, how you will get present value. I told you present value equals what? Future cash flows, but this cash flows I need per annum multiply by annuity factor, which I'll select from the annuity factor table. But for that, I should know what is the rate of interest and number of years for even cash flows. Then I can pick this value. So now, guys, please let's understand. So I want to just show you first thing. What is annuity factor? This word I'm going to explain only. This word, annuity factor, what it means. So I'll show you one thing here, very conceptually. It is not something difficult, very simple. Look at here. Okay. So for example, you have 3 years period, year 1, 2, 3. And these are present value factor, or let me write this way. We have a 3 years, year 1, 2, 3. And we have a present value factor here. This is years. Here we have a PV factor. And this PV factor I'm taking from $1 table, which I told you previously. Okay, for example, PV factor at 10%. At 10%, if you will go to the table of $1, you will find this value 0.909 for year 1, for year 2, 0.826, and for third, 0.751. And cross check these are the same value or not. Just go to present value $1 table. This is the present value of $1 table in front of you. Present value of $1 for 10%, 0.909, 0.826, 0.751. Okay, great. So these are the three values, right? Now, please. Now, what is annuity factor? I'm telling you. Annuity factor, because this is the present value factor. Okay, this is the annuity factor. Now actually annuity factor is the summation of present value factor. What I said, annuity factor is the summation of present value factor. For example, if I want to take annuity factor for year 1, I'll just add year 1 present value factor. So obviously it will be the same, 0.909. Check, it is same than annuity table. This is annuity table. Add 10% for year 1. So it is 0.909. Now look at here. In second, if I'll add now these two present value factors. So these two present value factors are equal to annuity factor of second year. Just add these two values. So we'll take 0.909 plus 0.826. It is going to be 1735. Now check annuity factor for second year. It will be this value. 1.736. Okay. Now if I'll add these three present value factor, these three, I'm adding three present value factors now. It will give you annuity factor for third year. If I'll add all these three, so it is going to be 2.486. And see, this is the annuity factor here, 2.486 for third year. See, it means annuity factor is what? It is just simply summation of present value factor. Summation of present value factor. And now, guys, look, there are three ways to get annuity factor. Number one way is what? Simply add present value factor for X number of years. For example, if you want annuity factor for 5 years at 10%, go to the 10% column, go to the $1 table of present value, add 5 values. You will get, for example, annuity factor, this one, if you will add those 5 factors. Second way is what? Second way, you can use table. Table is readily available. And third is what? There is a formula to calculate annuity factor. And this is the formula to calculate annuity factor. And this formula you may not be able to apply in CMA exam because scientific calculators are not allowed. But this is the formula. It will automatically do that thing. For example, what's the formula? So you will take 1 minus 1 plus r raised to power minus n divided by r. Do you remember the formula for present value factor? Do you remember? Present value factor, I told you 1 plus r raised to power minus n, right? Right or wrong? If I'll take simply this same formula, 1 minus this divided by r. So this will give you annuity factor. For example, if rate of interest is, let's assume 10%, r is 10% and n is 3, and I want annuity factor. So I'll apply this formula. I'll take 1 minus 1 plus r raised to power n divided by r. So 1 minus 1 plus r is 10%, so 0.1. N is 3 years, minus 3, divided by r is 0.1. So if I'll solve, it will give you 2.486, which is the same value here, 2.487 or 6. It's rounding difference, okay? Understood, guys? So it means there are three ways to get annuity factor. One way is what? Simply add present value factor for X number of years. Second way is what? Look into the table of ordinary annuity table. And third way is that what? Apply this formula for annuity factor. 1 minus 1 plus r raised to power minus n divided by r. Okay, so this is what is the annuity table. And I told you use of annuity table. Now I'm going to a little bit in more detail. So simply just I told you, simply now I will tell you actually more little bit tricky calculations by using annuity. Okay, first I told you what is annuity table and what is annuity factor and what is annuity table. So now guys, please remember here. Now we are going to talk about types of annuity. It is little bit new things. New thing means say in terms of application, when you apply annuity table on cash flow. So cash flows may have different pattern. So that pattern I'm going to teach you. So how you will use this annuity table in different situation. So I'll tell you most possible 3 situations. So first number, guys, number 1, we have a types of annuity cash flows I'm going to talk about. So there are 3 types of annuity cash flows. One is called, please remember here, I'll explain from here. So there are 3 types. One is called ordinary annuity. For ordinary annuity, there is another name which we can use that is called annuity in arrears. It's same thing. I'll write it in. Ordinary annuity is also called annuity in arrears. Okay, and then we have an advanced annuity. Advanced annuity is also called annuity due. Annuity due. And third is called delayed annuity. Okay, delayed annuity. So 3 terms are there. Ordinary annuity, which is also called annuity in arrears. Advanced annuity, which is called annuity due. Third is called delayed annuity. Okay, these are 3 types of annuity cash flows. So what it means. So I'm going to explain now. Ordinary annuity. What is the ordinary annuity? What's written? It's written. Ordinary annuity means the first cash flow will start from year 1. So what it means? Let's see. This is timeline. So this we have a year 0, year 1, year 2, year 3. Okay, and now in question he told you that you are going to receive $100 each year for 3 years. But first $100 you will receive at the end of first year, then 100 you will receive at the end of second year, then 100 you will receive at the end of third year. This is called ordinary annuity, where first cash flow will arise in year 1. This situation is called ordinary annuity. Okay, when first cash flow will arise in year one. Please, I'll tell you here calculations also with each time. So don't forget, first cash flow will arise or will start from year one to onward. Okay, so now here how if this is a scenario, if first cash flow is arising, okay, from year one. So in that scenario, how would you calculate? Okay, how would you calculate present value? So formula is very simple. So present value you will calculate this way. You will take annual cash flow multiply by annuity factor. I'm going to apply this. Present value equals to annual cash flow multiplied by annuity factor. So how I told you this previously also, same thing I'm going to repeat. For example, this is the annuity table. This is from annuity table. So you got rate of interest 6%, 8%, at 10%. These are number of years and these are annuity factor at different percentages for different years. So now, for example, I'm saying that my example is, let's say I'm saying that, so there is, for example, three even payments are receipts of 1,000 each. And first payment you will receive at the end of, for example, uh, or let's make it four even payments. Okay, four even payments of 1,000 each. Okay, and now look at here. And first payment you will receive at the end of first year. So it means it's ordinary annuity now. So if you will make a timeline 0, 1, 2, 3, for example, 4, it means first payment you will receive here 1,000, then you receive here 1,000, then 1,000 here, 1,000 here. This is ordinary annuity because it starts from year one. So in that scenario, how you will get present value? Very simple. You will take present values equals future value per annum, cash flows per annum, and multiply by annuity factor. Future value per annum is what in this example, $1,000 each. Multiply by annuity factor. When you are selecting annuity factor, so you should know percentage. I'm assuming rate of interest is 10%. I'm assuming R is 10%, for example. If R is 10%, so what I'll do, I'll go to the 10% column. And this is for how many payments are there? Four payments, four even cash flows. So I'll go to the 4 year and I'll pick this value, 3.170. So it means $1,000 multiplied by 3.170. So this will give you what? Present value of how much? $3,170. This is ordinary annuity. In ordinary annuity, you don't need to do anything. Simply you have to just look the annual cash flow and look into the annuity table. Okay, and select the annuity factor by looking at the percentage and years, and then multiply with the per annum cash flows. You will get present value. This is ordinary annuity, which starts from year one. Now let's change the second case. The second scenario is called what? Advanced annuity. Advanced annuity. It is also called annuity due. Annuity due. What is annuity due? So let's understand first pattern of cash flows. Under annuity due, so first cash flow will arise today. Today, for example, first payment receipt will arise today. For example, if you have a three even payments, but starting from today, so then you will write that 0. In year 0, you will write today 100 at the end of first year, at the end of second year. So it means this will give you, these are three even payments, but starting from today. So first cash flow will be placed in year 0. First cash flow will be placed in year 0. Okay. First cash flow you will write in year 0, second you will write in year 1, and third you will write in year 2. So this is what is called now annuity due, advance annuity. So in that scenario, how would you calculate present value now? Please remember, guys. Now, for example, let me write the example now. Okay. In that scenario, you have to pick annuity factor for 2 years, annuity factor for 2 years, and then you will add one into that because today $100 is always equal to $100. So today annuity factor or present value factor in year 0, annuity factor or present value factor both will be 1 always, because today $100 is equal to $100. So we should multiply with 1, so you will get $100, right? So now in that scenario, if you have advanced annuity, I'm showing you here how you will calculate present value. If you have an advanced annuity, this is advanced annuity case now. Okay, so you will calculate present value equals annual cash flows. Annual you have to pick per year, per annum. Multiply by 1 plus annuity factor. So let's do from here. For example, again, we have this table. This table you have now. This is the annuity table. And just I'm telling you use of annuity table in case if you have a advance annuity or annuity due. So now my example is same example I'm taking, just changing one thing here. I'm saying that rate of interest is 10%. And there are 4 even payments or receipts of 1,000 each. That's it. And I'm saying that starting from today, the first payment or receipts will be in 0. Starting from today. From today means to say starting in year 0. From today. So it means now you write cash flow like 0, 1, 2, 3. So in first payment will be here 1,000 or receipt will be here 1,000, 1,000 and 1,000. So 4 payments are there now, 4. Right. So 4 payments will end at the end of year 3 because first payment is today. Right. So what I'll do now? So how I'll calculate the present value factor? How I'll calculate the present value? So now I'll apply this formula. What is the formula? I will take present value equals future value per annum. I would say cash flow per annum multiplied by annuity factor plus 1. This is really important now. Future value per annum is how much? $1,000 multiplied by annuity factor because this payment ends on year 3, right? Starting from today, ends on year 3. First, I'll go to 10%. I'll pick year 3rd annuity factor. This is annuity factor 2.487. And into that, I'll add 1. Why 1? Because today, present value factor in year 0 or annuity factor is always 1. So this one, this one representing year 0 actually. So this representing 3rd year annuity factor and just I added 1. Understood? So if I'll multiply now, I'll get here present value. Okay, by using annuity, and this present value is going to be 3,487, I believe. 3,487. This is called what? Annuity due. So I'm just giving another example. For example, now just change the percentage. What you will do, tell me, and change the data slightly. So for example, now I'm saying that rate of interest is 6%. So there are 3 even cash flows are there. Okay, 1,000 each. Starting from today. Starting from today. It means how you will now in the timeline you will write 0, 1, and 2 only because 1,000 you will receive here, 1,000 you will receive here, 1,000 you will receive here. So now because there are 3 payments, it will end on year 2. So how you will calculate present value factor now? Sorry, present value. So you will write present value equals future value per annum multiplied by annuity factor plus 1. So future value is 1,000 multiplied by annuity factor. You have to go years 6%. For how many years? 2 years. 2 years. I'll pick this value 1.833 and I'll add 1. 1 represent year 0, 0. So if I'll solve it, so now I'll get present value here. This is how you will work with the annuity due. I hope so it is clear. Now I'm going to tell you here delayed annuity. This is really important. Delayed annuity, third scenario. And here people are making mistake. Okay. Even this delayed annuity is not written in your CMA book. So, but I'm explaining here because sometimes they may give you question on this. So delayed annuity, what is delayed annuities? Here we go. So delayed annuity means like, for example, if this is, let's assume you, there's a project and project life is, let's assume 5 years. So, or 6 years. So we'll write year 0, 1, let's assume 2, 3, 4, 5, 6 years. Okay, this is how we'll write. And now in exam question, he told you. So there are, for example, what he told you, he told you there are 4 even cash flows of 1,000 each, but starting from 3rd year. I'm just saying, starting from 3rd year. Okay, 3rd year. By the way, I wrote the years according to this. Okay, so starting from 3rd, what it means? It means first inflow is not arising in year 0. So it is not advance annuity. It is not arising at the end of 1st year also because it will start from 3rd year. But there are 4 even cash flows. Start from 3rd year. It means it's starting from this point. So 4 even cash flows. It means one cash flow will be placed here. 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 So this is what is your 4 even payments you have written. But it's not started from zero. So it's not advance annuity. It's not starting from year one. It's not ordinary annuity. So it is called delayed. So delayed annuity, how you would define the annuity which will start after year one. Maybe it can start after year two, at the end of year from the year two, or maybe it can start from year six to onward, three to onward, five to onward. So this is what is called delayed annuity. And now challenge is how to find out the present value in case of delayed annuity. It's really, really important. So here we need to adjust annuity factor. Okay, and present value, I told you how you will do now. You will take your future value per annum, multiply by, you have to adjust annuity factor. Adjusted annuity factor you will take. Or there are two-step approach, I'll tell you. I'll tell you two ways, guys. So whatever way you will remember, it's easy that you can, whatever the way you will find it's easy, so you can remember that. So I'll tell you here two ways, okay? Two ways to find out present value in case of delayed annuity. So let's have a look with the help of example how you are going to work. So let's understand how it is going to work. Please, I need concentration here. So let's assume if we have a $200 is incurred each year for 4 years. Like it means even cash flow is $200, but this even cash flow is for how many years? 4 years. But starting in year three, starting from third year, it means there are 4 even payments or receipts are there, but those payments or receipts will start from year three. And if rate of interest or discount rate is 5%, so what's the present value? So now guys, there are two different ways are there. Okay, two different ways are there. First way, this is bit, I mean to say, I would not say it's tricky, but both are understandable. So just you have to go through. So let's have a underlook. Let's have a look. So what is the first way? So first way is that, guys, I need concentration here. So what I'll do, first way, this is the first way. I need to know what is R. R is 5%. I need to know how many payments are there. 4 even payments are there, which is $200 each. Right or wrong? But I also need to know when it's starting. It's starting from 30 years. If you will look into the timeline, please. If you will look into the timeline now, I'm using this data, whatever is written there, $200, 4 payments starting from 30 years. So you can draw a timeline now. Please, I need concentration. So let's this is timeline 0, 1, 2, 3, 4, 5, 6. This is timeline. And it's starting because there are 4 even payments are there. Starting from third year. This is third year. Na? One payment is here, second payment is here, third payment is here, fourth payment is here. So 4 payments are there starting from third year. Now I want to calculate present value. So what is the first way? First way is what? Is that first way. First, what I'll do? Simply, this is the first way. And in the first way, two steps you have to do. Number one step is what? Present value equals cash flow per annum multiplied by annuity factor of 4 years. Why 4 years? Because there are 4 even payments at 5% because the rate of interest is 5%. This is the first way. Simply, I'll go to the annuity table. Annuity table. I will look at 5% column. I will look into the 5% column for fourth year. If you will go there into the table, I'm not sure. There's the table. This is the table, I believe. Annuity table, yeah. So what was the rate of interest? 5%. Right? And for fourth year, this is the value. How much? 3 point. It was 5%, right? So 3.546. First, I'll do this. So 3.546. This factor I'll took from there. So now I'll multiply 200 with this. I'll get here present value. So present value, whatever value it's hidden here now. So if you will multiply 200 multiply by 3.546, it is how much? It is 709.2. This is the value, present value. Okay, this is the first way. Then what you will do? Now, guys, actually, then you have to do the second step. So let me tell you here what is the first step. If this was your timeline, when you follow this way, which I'm telling you now, so you applied 4 year, you applied fourth year annuity factor, what it will give you. So just draw the line here first, 1 year back, even it's starting from third year, 3, 4, 5, just draw a line here. Hypothetically, we are drawing this line here. Okay. Okay. Why? I'll tell you later. Because reason is that, for example, when you calculate present value, it start from 0, 1, 2, 3. So present value factor we apply from here, it always give you value 1 year back. So that's why if you are ND factor you're applying from here, so it will give you a value at 1 year back. So what we are doing here, once you calculate what is the value we got, 709.2. Actually, the 709 which you got it here, this value you got it at this point, 709.2. Now this value you have to bring it to the year 0, present value. Now this is the first step. When I took at 5% fourth year annuity factor, so it means I'm bringing this value to year 2. Okay, 1 year back. And now I want to bring this value from this point to this. One more step I need to do. What is that step? So that step is, now what I'll do, whatever answer I got, the second step, then multiply this answer with the PV factor, not annuity factor, present value factor, okay, of second of year 2 as per this data, because I want to bring back this value from year 2 to 0, from here to 0. That's why I'll take present value factor of year 2. I'll go to the present value table, present value table means a present value of $1 table. I'll check 5% for periods, 2 years. So this, I'll find this value there, 0.970. Okay, present value factor of $1 for 2 years. Now I'll take this value, multiply by present value factor of previous year, which was year 2. I'll multiply here what? I'll get here present value. And this present value, if you will just multiply, then I'll tell you other way. This is the first way, guys. 709.2 multiplied by 0.907. It is going to be 643.2. This is the one way. What is the one way? Look at the question data. Question data is what? There are 200 payments. These payments are 4 payments are there, but starting from third year, rate of interest is 5%. So it means what I'll do here, start 4 payments are there. So I'll take annual cash flows, multiply by annuity factor, because there are 4 payments. I'll take annuity factor of 4 years at 5%. I'll get one value. This value, then I'll multiply, because annuity starting from third year to onward, right? From year 3 to onward. So what is the previous year from year 3? It is 2. Then what I'll do, I'll take this value and I'll multiply with present value factor, which you will take from $1 table of year 2 at 5% to get the value in year 0. So then this value you will get. This is the first way. Second way is more easy and logical. What is second way? Okay. So now I'll draw this again timeline. This second way I'm telling you. Timeline is what? This is, please remember here what we have to do. Second way. So I'm removing this now. So what was the data? Don't forget the data actually. Data is, this is the timeline actually we have already drawn. So we have $200 per annum cash flow. And there are 4 payments are there, but starting from third year, right? This is the data. Starting from third year. And rate of interest is starting from third year. And rate of interest is 5%. This is the information. So we'll draw a timeline here. 0, 1, 2, 3, 4, 5, 6. Why say? Because first payment will starting from third year, right? So first payment we will place in year 3, then year 4, then year 5, then year 6. So see, these are 4 payments. Now what I'll do? Secondly, I'm telling you. First, I'll go to 5% annuity table. Annuity table I'm using. Annuity table. I'll go to annuity table and see where my year are ending. Years are ending at year 6. I'll go to the annuity table. I will look 5% column and I will look for year period 6. Okay. So if I look that, let's see what's the value there. If you look that table, annuity table, I'm telling you, Okay, annuity table, I'm looking at 5% for 6 years. So this value I'll find it there. 5.08. This value will find there. Okay, now here logic. What is logic here? Look, if I take this annuity factor for year 6, because I took for year 6 at 5%, so it means this factor will include all present value factor from year 1 to onward, right? Because I told you annuity factor is what? Annuity factor is the summation of present value factor. It means if I'll take annuity factor at year 6, sorry, at 5% for year 6, so it includes all present value factor. But my annuity starts from year 3rd. I don't want this. I don't want year 1 and 2 factors into that, right? So what I'll do first, I'll do what? First we will take year 6 at 5% annuity factor, and then from there I'll deduct annuity factor of year 2, because year 1 and 2 I don't need, because my annuity starts from year 3rd. So this 1 and 2 annuity factor at 5% for second year I'll deduct. So now once, see, this was 6 years annuity factor. This is 2 years I'm deducting. Automatically you will get for 4 years annuity factor. Okay, but 4 years mean to say this 4 years means it's from year 3 to 6. These are 4 years, right? So year 3, 4, 5, 6. So these are 4 years. So this is called adjusted annuity factor now. So I'll take this adjusted annuity factor. Okay, now I'll apply this formula. Present value multiply equals cash flows per annum multiplied by adjusted annuity factor. This is the adjusted annuity factor. So now 200 per annum was annual cash flow, 3.217, because it's rounded value here. Okay, it is 217 by the way. So if you will multiply here, you will get this present value. See, this value or this value is the same. Maybe there might be a little bit rounding difference, but these are two ways are there to deal with the annuity factor. Understood? I hope that is clear. Is that clear, guys? Now, guys, there's another scenario. Annuity is over. I told you how to deal with ordinary annuity, advanced annuity, and delayed annuity. Now I'm going to tell you perpetuity. So this is another scenario, perpetuity. So perpetuity means infinity, actually. So what is perpetuity? So guys, please remember in perpetuity, these three conditions should be there. Number one, there are even cash flows. Like for example, maybe you are saving $200, $200, $200 every year. These cash flows are occurring after regular interval. These both points were there in annuity also, but third point is different now. But here time period is not known. In annuity, we said even cash flows occurring after regular interval for definite time period. But in perpetuity, the time period is indefinite. We don't know. For example, I'm just saying, let's assume I'm saying that I'll give you pension, $1,000, right or wrong, until you are alive. So we don't know. $1,000 you will get every year or every month, but we don't know your life. God forbid. I'm just saying. So now this is called what? Perpetuities. Even cash flows are there occurring after regular interval, right? But it is for indefinite time period because time period is not defined here. Time period is totally undefined. So that is called perpetuity. In perpetuity, guys, please remember. So how we will calculate present values. Usually what we do, usually I told you we take present value equals future value multiplied by 1 divided by 1 plus r raised to power n. And I told you this is called present value factor. But now n is not known. So formula will become this one simple. This is the formula for perpetuity. How to get present value in perpetuity. Okay, so first present value, how you will get? This is simple, I'm telling you. Cash flow multiplied by 1 over R. So 1 over R is called perpetuity factor. Understood? So now here, guys, again, there are three types of perpetuities are there. Okay, I don't want to make it complicated. I'll just make it, I'll just try to make it simple. So how you will calculate now, guys? Present value in perpetuity, again, there are three conditions are there. Condition number one is what? Ordinary perpetuity. Ordinary perpetuity means what? For example, your first cash flow will arise from year one. What it means? For example, I told you, let's say this is year 0 and this from year 1 to infinity. I told you I'll give you $1,000, okay, until you are alive. So it means but first $1,000 I'll give you from the end of first year. It means you will get $1,000 from here to onward, right? To infinity. So this is what? Ordinary perpetuity. It's called what? Ordinary perpetuity. Okay, or perpetuity in arrears. So in that scenario, how you will get, because your first cash flow is rising at the end of first year. Here how you will get present value. Present value equals what? Annual cash flow. For example, whatever I'm giving you, multiply by 1 over R. That's it. Okay, for example, what is the present value of $3,000 received in 1 year and forever if the interest rate is 10%? So what it is written? So it means you are receiving first cash flow in the first year, but it is for indefinite time period. Understood? So what's the present value? So here how this formula you will apply. Annual cash flow is how much? $3,000 multiplied by 1 over R. R is what? 10%. So 1 over 0.1. So if you will solve, you will get here present value. That's it. But now if you have a advanced perpetuity. Advanced perpetuity is what? Advanced perpetuity is like that. For example, perpetuity of 2000, like you will get $2,000 every year, is due commence immediately. Like here it means what? First cash flow you will get today. Today means it from, let's say year zero, from year zero to infinity. This scenario is what? Year zero to infinity. First cash flows you are receiving in year zero, for example, $1,000 to infinity. In that scenario, how would you get present value? This is called advanced perpetuity. So I'll just amend the formula. With this 1 plus 1 divided by R, I'll simply add 1. Because one represent year zero, okay? So how you will get present value? This formula you will apply here now. You will take present values equals annual cash flow, which is $1,000 into 1 over R. R is 0.10 plus 1. That's it. So 1 over R plus 1. So this is called what? Adjusted perpetuity factor. Now just you will multiply with this, you will get present value. I hope so it is clear. So for example, they are saying 2000 due to commence immediately, but interest rate is 9%. But here point is what? So you are getting 2000 today to infinity, to infinity, to infinity, I'm assuming. So what's the present value? So you will take what? Present value equals future value per annum, which is 2000 into 1 over 0.09, because R here is 9 and plus 1. If you will solve, and you will get here what? Present value. That's it. Then we have here, guys, last scenario, which is called delayed perpetuity. Here is little bit, let me just tell you how you find present value of delayed perpetuity. Delayed perpetuity is what? Delayed perpetuity mean to say, for example, if this is the timeline year 0, 1, 2, 3 to infinity. What I told you, I'll give you $1,000 for indefinite time period, but first $1,000 I'll give you in year 3. It means it's starting from year 3 to infinity now. Okay, there is no cash flow in year 0. It's not advanced annuity. There is no perpetuity. There is no cash flow at the end of year 1. There is not ordinary perpetuity. It is delayed because it starts after year 1, maybe year 2 to onward, 3 to onward, 10 to onward. So in that scenario, what you will do, guys? Simply, for example, in my scenario, I'm saying R is 10%. So how would you do it now? I'm saying it's starting from third year to infinity. So now this formula I'll apply this way. Present value multiply by future value present value equals future value multiply by 1 plus 1 divided by R, one thing. And this I multiply with the present value factor of previous year. See how? For example, future value is $1,000 in my example. Multiply by 1 over R, R is 10%, 0.10. And multiply by, because my perpetuity starts from year 3 to onward. What is previous year? Previous year is 2. Now I'll go to present value of $1 table. Present value $1 table. And I look at 10% for year 2. Present value factor. Present value factor. If you will go to $1, present value $1 table, look at 10% for year 2, it is 0.826. If I'll now solve this and multiply with this will give you present value. Another example, for example, I'm saying that, let's assume R again 10%, and I'll give you $1,000, but it starts from year 2 to infinity. So how you will get now present value? So you will take present value equals annual cash flow is $1,000 multiply by 1 over R. R is 0.10 multiply by present value factor of previous year. And what's the previous year? Previous year, because starting from year 2, previous year will become year 1. So I'll go to 10%. At 10%, I look for year 1. Year 1. But what I look present value factor from $1 table. If I'll go to $1 table, I'll find this value there, 0.909. It means I'll solve this, and I'll multiply with it. So this will give you present value. So guys, this is what is the time value of money concept. So in today's class, just we discussed what is the time value of money, how it works, what is compounding, what is discounting, a present value, future value, and then I told you future value means a compounding, present value means a discounting. Then I told you how to apply the tables in case of annuity. We have a ordinary annuity, annuity due, and delayed annuity. Then I told you how to apply with the perpetuity. I hope so it is clear, right, guys? Thank you so much.